Well, good morning. Thank you very much. I'm very excited to be the speaker on this very exciting topic. Show of hands, who's participated in a crowdsource funding campaign? Okay. Has anybody participated in an equity crowdfunding campaign? That's good because that's not legal. Just checking. Okay. Just to give ourselves some background on basic Securities Law 101. Securities Law 101 stems from the 1933 Act that protects investors from fraud. I'm putting this really briefly because we have a lot to go through very quickly. I'll venture to say I'm one of the older people in the room, going back 30 years as a business lawyer, but started with the SEC when Regulation D came out. And Regulation D created a series of exemptions that allowed companies, issuers, to offer their securities in private placements. And private placements were exactly intended to be that, private, not subject to general solicitation. These are concepts in your securities law background that you're going to need to understand crowdfunding. So crowdfunding, whoop, I should have gone like this. That's me. Oh, there you go. Where did crowdfunding come from? It comes from, these are a little out of order. The legislation passed in April of 2012 by Congress. Congress decided that the Great Recession had encouraged everybody in Congress to do something about creating jobs. And they passed the Jobs Act, which stands for Jumpstart Our Business Startups. And Title III created the crowdfunding exemption from registration. We talked about Reg D being private placements. Well, Reg CF, crowdfunding, is a private placement as well. You do not need to fully register with the SEC in a prospectus-like public offering in order to sell your securities under this exemption. It's a brand new exemption under Section 4A6 of the 33 Act. And it really, that's the kernel of importance for the Jobs Act, was to recognize that they needed a new avenue for small business and startups to get access to capital. Reg D wasn't cutting it. The other thing that this section, or Title III, is important for is that it now has come into the 21st century and decided, you know what? We're not doing this on paper anymore. This is going to all be done online. So the entire offering transaction, the process of the transaction, the vetting of the issuers and the vetting of the investors will all be done online by another new concept called gatekeepers. So just spelling it out to give you sort of a follow along, crowdfund is essentially money is coming from the crowd, capital is coming from the crowd. This is very limited in the amount of capital that you can raise. It's going to precede our venture round in almost every circumstance. I can't imagine anybody doing a crowdfunding capital raise afterwards. So we're raising only $1 million. $1 million is, this limit is a big point of objection to a lot of people. But having sort of worked with small business and startups my entire career, I can tell you that $1 million to a startup can mean a lot of money, as long as it doesn't cost too much. So it's $1 million that can be raised in any 12-month period, measuring 12 months back. We're doing it all online, and we're at this simultaneously while we're protecting all those investors from fraud and non-disclosure of material information. And I put this circle up because I just wanted everybody to sort of see who the players are in a typical crowdfunding event. We have our startup issuer who's creating securities, in my opinion, will be creating securities that are designed specifically for the crowd. In a venture round, you might be looking at common, preferred, with variations on themes. I'm anticipating that the capital structure for my crowdfunding clients will have what I'm calling Class X common, because it's just so brand new. And it's going to probably not carry voting rights, because I'm going to suddenly have potentially 1,000 new shareholders who I really don't necessarily want to hear about their votes at every annual meeting. This is all going to be decided in terms of the marketability of the securities. And the SEC has decided in the proposed regulations, which came out in October, nearly a year and a half after the legislation was passed, they've decided not to regulate the types of securities. So they're basically saying to the issuer, you do all that you have to do to file the Form C, which we'll touch on briefly. You work through the funding portal or the gatekeeper who's been registered. You comply with all the disclosure requirements that the SEC regulations require. Money's handled appropriately by an escrowee, and you succeed in your offering. You can do it with common, you can do it with preferred, you can do it with debt, you can do it with any type of security, and they're also favoring dynamic pricing. Not sure how that's going to work, because when you go out to market with an offering with a $10 share price and you sit on the portal for 6 months and nobody buys it, you might want to rethink about pricing, and they're going to let you reprice it. But that's going to require subsequent filings. It's a material change of the terms of the offering. So the delay in passing the proposed regulations, which, by the way, are 595 pages long, a very big snooze for people who aren't excited about this. But in that 595 pages, they have probably asked for comment on 250 different items. I can give you no guarantee or assurance that what's in the proposed regulations will be in the final regulations, but everything I'm hearing from colleagues, and I've been to many seminars on this topic, is they think the proposed regulations are as close to the final as we're probably going to get. And they're also expecting those to go live this summer. So basically, I've decided to frame our discussion of crowdfunding around the 3 drivers of personal behavior: fear, desire, fear, and greed. My homage to Hollywood. You two all are way too young. Even I'm too young to know this. But when you Google images of desire, strange things come up. This happened to be a 1936 film called Desire, so I chose the politically correct one. So where does the desire come from? Well, the desire is across the board. Congress was so desirous of creating or perceiving to do something about the unemployment rate that jobs have become the new currency, and anything that they can do to create jobs is just absolutely wonderful. They want to be perceived as being on the main side of Main Street, not on Wall Street. And they also, and this is true and has been true my entire career, small business accounts for fully 2/3 of all the jobs in the US. So they recognize that small business is where the job creation occurs. I would say the other part of desire is that there has been, as a result of the Great Recession, a huge funding gap. We all know friends, families, and fools have their limits on how much they're willing to commit in the way of capital to startups. Commercial lending has essentially dried up for this product. And we also have no more home equity to borrow against, which is one of the sources of capital that I've seen used over and over and over again. So there's a desire built around the fact that we're missing this huge funding gap. And of course, the other desire comes from your desire. All the people in this room who have taken it upon themselves and have the passion to create and build something of value for yourself and for your family and for the world. And America seems to be blessed with a lot of those folks. Well, we have to balance our excitement and desire with fear. Bottom line here is that we are all afraid, people are all afraid that fraudsters are going to use crowdfunding as a way to rip off grandma. Some people have referred to it as the FOG Act, fraud on grandma. I'm not picking on grandmas. There are other people who make mistakes as well. But this is the bottom line fear. So when the regulations were written, they were written for the purpose of really attacking what are the threats to the investors. What threatens an investor from making a good decision? Okay? So we created the gatekeepers. The gatekeepers are the registered broker-dealers that exist already in the market, and a new entity called a funding portal, which is being regulated by FINRA, which is an association that regulates financial institutions, not banks, but brokerage and that sort of thing. And basically what they're saying is that we'll let you be a funding portal, but here's what you have to do to protect the people who come to your site wishing to invest. First of all, they have to be registered. They have to be registered with FINRA. They can't do that. They can't initiate a crowdfunding engagement with an issuer until they're registered. They must also do their due diligence on the issuer. They have to determine whether the company that's offering the securities is really real. They've done background checks on the people who run the company. They've went to the website to determine whether or not they're properly incorporated, that they actually have the classes of securities that they're offering. They're actually vetting out those people to determine whether or not they're bad actors. They have to do the background checks to cover the issuer, the officers, directors, and anyone and a 20% beneficial owner of the company. The intermediary is doing that. The SEC is a depository for the Form C, which is the disclosure statement that we will have to prepare, but they're not doing a pre-offering review. They're not, the rules are indicating that they're not going to be doing a pre-offering review. Sorry? There's no fee to file with the SEC. No. So the intermediary becomes the regulatory review arm of the SEC to a degree, looking at the issuer, looking at the owners of the issuer, determining its validity. The other big element of investor protection that the intermediaries are charged with is they must also look at each and every investor who comes to the portal. This is done all online, by the way. There will be no mailings to and from an intermediary to an investor. And investment is limited. An investor cannot make an investment that's beyond their financial means. Go ahead.
When you say these portals are registered, are these like investment firms or broker-dealers, or what are they?
Well, there's actually an association already formed called Crowdfunding something Association. I can't remember the CFINA, and they're Rocket Hub. There are already groups, and there are many people who testified in Congress in favor of this. They got FINRA to give them a FINRA Lite registration so that they didn't have to go through the certification and testing process to be a fully registered broker-dealer. You can use broker-dealers as well. They're qualified to do crowdfunding, but we'll have to wait and see whether or not they want to venture into that market. I perceive most of these transactions to be handled by the new funding portals. Rocket Hub is a good example. They were very vocal in their testimony. So limiting the amount you can spend. We don't want you to invest in this idea, this business, this startup, if it's going to bankrupt you. So you can only invest $2,000 or 5% of your annual income or net worth if either of those amounts is less than $100,000. If you are more wealthy and your annual income or your net worth are higher than $100,000, you have the ability to invest 10% of the higher amount, up to a cap of $100,000. This is another area where people are disgruntled because they want to have the ability to have richer, more sophisticated investors invest more money in crowdfunding events. That really is contrary to the legislation, because the legislation is trying to democratize securities offerings and ownership amongst the general investing public. So go ahead.
So if I invest 2,000 or less, I don't have to verify anything?
Say it again.
If I invest 2,000 or less, I don't have to verify anything?
Verification of income based on the proposed regs looks like it will be you signing a representation and warranty to the intermediary. You will not necessarily be providing them tax returns and such. Right. At least that's what we see now. In the final rules, we'll see, but that's what we're looking at now. So limiting the amount of the investment is essential too, because again, we don't want to bankrupt people, but we also want the ordinary investing public to be able to participate. All of this happens online, so the platform that the intermediary will have to have in order to pass muster to be a qualified registered funding portal has to be online, and they have to have the ability to vet the issuer, they have the ability to vet the investor, and then they have the ability to get the investor to agree to all electronic transmission of all communications and notice. You will be able to go to the websites when the offerings come up, and you will be able to participate in a discussion about the various offerings that are on the portal, but only after you have agreed and signed up to take electronic delivery and notices. Because the chat rooms that are going to be available, they do not want people who are just tire kicking or window shopping and have no commitment to the process. You first must commit to the process, and then you have the opportunity to go in there. And this is very critical. Keeping an open channel of communication on the portal is going to be required for the portal to remain a registered portal. So it'll be an interesting experience to see, once you've got your offering out there and the information is disclosed, what kind of conversations will be going on in those rooms. And just so you know, the law also requires any promoter or any officer of the issuer, anybody associated with the issuer, who goes into a chat room to talk about the offering, they must disclose in their conversation that either A, they're being paid to do this, or they're already an officer or director of the entity that's offering the securities. Another form of protection. We spend a little bit too much time on fear, but I just want to cover some other brief elements, and there are a lot more, but we can talk about later. There's an element of investor education that the portal must provide. They must tell these people that this is not, this is a highly risky investment. You could lose all your money. You need to understand that when you buy these securities, you may have to hold them forever. You may never be able to sell them. These are all those risks. I don't know if you have, all of you, seen the standard private placement memorandums that you see in the 20 pages of risk factors, dilution, and all the things that we talked about, securities, non-voting, what's the characteristics. It's on the intermediary to make you, before you get access to the portal, to go through an educational process and click through that and say, okay, I get it, I get it, I get it. That's on them. So let's say, and then there's a 21-day pre-sale notice period. No sales can occur until 21 days after the Form C has been filed with the SEC and the portal has put up the terms of the offering and the disclosure statement. and all the financial information that's required by the regulation. Once that starts, then the portal is able to monitor the commitment level, but they're not able to offer you advice, give you recommendations, or take control of your money. Those commitments then go to an escrowee, which will typically be a bank, and the bank will essentially hold the commitments until the target number for the offering has been met, and then we succeed, we distribute, and you've got now the equity that you purchased. Whether that's common stock and how much percentages will all be disclosed in the offering. Portals, the SEC elected not to try to regulate how portals are paid by issuers. There was lots of discussion about should a portal be paid by a commission based on the amount raised. And people were a little concerned about that, but the SEC has decided not to regulate that, so it is possible that, and likely, highly likely, that when you go to your portal and negotiate your engagement agreement with them, you will be paying probably between 5 and 10% of the amount raised to the portal to be doing the work that they're doing to help you make your offering qualify for the exemption and be compliant with the anti-fraud laws. This is not unusual for us now because we're used to Kickstarter and Indiegogo, who charge anywhere between 4 and 8% of a campaign raise for their services. So it's not, it's not free because we have to pay for those services, but they have decided that the intermediary, the gatekeeper, cannot have a financial interest in the issuer, which means that, yes, they can get their commissions on the capital raised, but they cannot take an equity kicker from the raise. So they can't take a warrant. They can't take that for their services because they would have a financial interest in the issuer. They're trying to keep that transaction, that financial transaction between the intermediary and the issuer, kind of clean and unconfusing. So fear we're trying to allay with appropriately regulated intermediaries, rules on disclosure with Form C, which is a universal form, but we still have to address greed real quickly. I mean greed in the best way, in the sense that it's appetite. There is an appetite for this. We see it a lot, and I'm briefly just going to cover the facts of Oculus. I don't know if you guys know about this, but in the fall of 2012, Oculus came out with a product that's a virtual headset thing. I have no idea anything about that, but they raised $2.5 million on Kickstarter. 6 months later, they got $16 million on their Series A round with Spark Capital. They got $75 million on their Series B round. And they, this last 2 months ago, were sold to Facebook for $2 billion. The people who contributed $300 to the Kickstarter campaign got t-shirts, posters, and development kits, which won't be any good anymore. Had they participated in this in an equity basis, they would have walked away with $44,000 in cash. This is the appetite that's out there for this product. Now I think there might be a lawsuit.
I guess that's a question, because when I look at all the Kickstarter campaigns, none of it says you get X amount of percent of the company, you get a free t-shirt, or you get X. So why is there all this background stuff going on for regulatory on crowdfunding if the majority of crowdfunding doesn't give you equity in the company?
Because it's not crowdfunding, it's crowdsourcing. Okay? And it's not equity, it's donation.
Right.
So it's not regulated. The Girl Scouts, or people do fundraisers all the time at your school. Your kids, we got to have a bake sale. Yeah. You still have to buy the ingredients. Yeah. So this is the Form C, and it's also a universal form. We can talk any questions I can address to that later. the 595 pages, I will tell you, having been an ex-SEC intern, these people really are stodgy and don't like change. But they really wrote, I believe, we believe, we believe, we believe in this, and have done their very best, I think, to balance investor protection with the desire that everybody wants to see this happen. Okay, just a final word. It's not legal yet. You can't do it. So don't do it, and see a business lawyer before you do it. All right? It's not free money. It's going to cost, and you have to pay your intermediary, you have to pay your lawyer, but it's meant to break down the barriers between small business and capital. A small amount of capital, relatively speaking. It's not a panacea, but it's something. And just so you know, the latest development, I found out yesterday that Congress is now, people in the House are upset with the Jobs Act, Title III provisions. There's pending legislation by a Republican out of North Carolina to now further improve the Equity Crowdfunding Act, to loosen some of the restrictions. Whether that's going anywhere, I don't know. But I think it emphasizes the fact that Congress sees this as a real necessary bridge to capital. And a final note, as just found this out, which is extraordinary, some of the states have decided that they think crowdfunding at a federal level is way too restrictive. Washington, Wisconsin, Michigan, and Alabama have passed their own form of crowdfunding legislation, eliminating the intermediary entirely. Sorry? Probably nowhere. Yeah.
Now, in those 4 states, is that exclusive within the state, obviously?
Here's the deal.
So it's not like you can put your gambling shack down in the Caribbean?
It's not so much the location of your operations as it's at what's called an intrastate offering on a federal level. And the federal statute says if everything is done in state, it's really none of our business. And these states have taken advantage of that and said, you're darn right, it's none of your business. We're going to do this our way here. But you can only sell to people in that state who are residing there. So there's going to be more developments, but again, I look forward to the end of the summer being a really exciting time, and look forward to talking to you more at the clinic. Thank you.